Hi, this is Patrick Adams, and we have some really fun things to talk about this week. The biotech sector is heating up again. There's some really important news there. We think there's an opportunity to make some really good money in that sector. Secondly, we want to talk about a process that we use to concentrate positions and to also put risk management in place so you don't blow up on the downside. And thirdly, it's earnings season. We'll talk about the earnings a little bit and 2024 expectations. That's the key to the stock market at this point is 2024. We're almost done with the Fed raising rates, and the key is how these earnings hold up and how the economy holds up. So to start, Prometheus, ticker symbol RXDX. The Merck is buying them for roughly $190 a share. That's 10x versus where it came public in 2021. So this is a phase 2 drug. Keep in mind there's 3 phases to drug development: phase 1, phase 2, phase 3. The most important is phase 3. So phase 2 is proof of concept, and phase 3 is proof of that drug works or not. So this is really unusual for a company to be bought out on phase 2 data at such a high valuation. So this is the highest valuation ever. That shows you how much the drug companies need to go back and refill their pipelines. So Merck's going to have some holes in it, going forward over the next 5 years. They need additional drugs to fill up the revenue stream. So what's happening is that the sector's down in a huge way. It fell 65% from high to low. There's great value in these companies, and there's potential to make a lot of money in these stocks. So the company that we like the best, the biotech company that we like the best at this point is Bioexcel. It's an artificial intelligence drug development company. They developed a drug that got approved in roughly 3 years. That's extremely fast. So it's a agitation drug for schizophrenia and bipolar disease. It's on the market, so this is a real company. So they have a drug in phase 3, the same drug, in phase 3 for agitation of Alzheimer's. The data will come out this quarter, and agitation for Alzheimer's is a huge market. If they hit their data points, likely going to a new high. We see lots of upside potential to this stock. Currently $21 a share. We repurchased the stock at 17. Kind of the history for us is you go all the way back here to $10 a share is when we first owned it. Boy, it took a big nosedive to roughly $2 a share. We bought more stock there. It had a big run, right, up to $60 a share. We're gone. And then with the bear market in the biotech space, February of 2021 is where it started. Big decline. We repurchased the shares at $10. It runs to over 30, where we cut it back in a big way, and now re-entered it right in front of some critical data at 17 a share. So like this company a lot, huge upside potential. If it doesn't work, it's probably going back down to 10. So if it does work, it's probably going to 60 or maybe $100 a share. Big upside, like this one a lot. But just keep in mind, it's not risk proof. It could go down on you. It could go down 50% from this level. How to make money in a big way, how to make big returns without taking the risk. So there's 2 ways of doing it, or you can combine the 2, right? If the market goes down, you want to avoid it. The market's going up, go with the market. The market's going down, you avoid it. That's our philosophy, loss of risk investing. However, you can also concentrate your positions. So as a portfolio manager for 37 years running some big funds, I found it difficult to really love more than 10 stocks at a time. So you can fill out a portfolio with 20 or 30 stocks, but there's 10 that you really love. So you can concentrate a portfolio of 10 stocks, like Warren Buffett does, and protect the downside. So for each stock that you own, put a stop loss on it. Don't double down. Just put a stop loss on it. The stock goes down, you're out of it. If it breaks where your tolerance of pain is, don't hold it. Just get rid of it. You'll find another one. So by using these risk controls in place, you can get big returns on the upside and limit the downside. We've talked about this a few weeks ago, J&J, and I'm going to talk about it some more here in a minute. But J&J is a 10% position in this particular strategy. How I do this, like it a lot, like J&J. And then we have 9 other companies that we like in various degrees. But again, this is a concentrated portfolio and risk managed. I love this style of managing money. There's lots of upside potential to this approach and limited downside. So looking at the earnings. So we're in earnings season. It's important to understand kind of where we are in this process. So this is first quarter of earnings reports of 2023. Right now, the earnings for 2023 is $220. That's pretty flat versus last year at $219. We think ultimately the earnings come in lower than 2022, so lower than 2019, probably somewhere around $210 for the S&P 500. What's important to keep the market up, what's important is that the 2024 number is higher than 2023. You want to see that progression. And then to be able to make the case that 2025 is higher than 2024. So we're pretty confident in that 2024 is going to be higher than 2023, but we think both come down a little bit. So as we enter the recession, it's critical to have that expectation that next year will be up. If not, the market's going to significantly decline, if not go into a bear market. So far, the earnings have been great. So the banks reported last Friday. Some of the banks reported last Friday. They were really strong. JP Morgan, man, those guys are good. 56% earnings growth. They reported 410 versus expectations of $3.37. Blew it away. Revenue growth, almost 25%. The other banks that reported, again, really good results. 8% growth for Citigroup. That was a surprise. 21% earnings growth for PNC, better than expected. And Wells Fargo, really good report. So the banks so far have been really good. That supports our expectation that 2024 will likely be higher than 2023. Now, looking at what's coming this week, we have J&J on Tuesday morning, so probably be out before you see this video or read Mark in a minute. But we love J&J. If J&J goes down, buy it. We think that they'll probably report a positive earnings surprise like they did last quarter. The talcum powder lawsuits are all being resolved, so that's lifting the cloud from J&J. We think the stock is back to, previous high 180 this year, something like that. So that's still a very nice return for the $165 a share it is currently. And it's a very nice return from where we bought it at $151 a share. Now, Tesla reports on Wednesday. Tesla is such an interesting company, and the guy who runs it, Elon Musk, he's fascinating. However, we think that there's risk to the earnings because when they reported last quarter, which was better than expected, and the stock really ran on it, that the cash flow didn't match the earnings. So there's something going on there. We just think there's just some risk to the report. Just beware of that. On Wednesday, also, U.S. Bank reports, a great bank. If for whatever reason the stock goes down, I would buy it. On Thursday, 3 other banks report, Fifth Third Key Bank and Huntington Bank all should be reasonably good, supporting the thesis that perhaps 2024 will hang in there and not be lower than 2023. Now, we are currently in stage 3. If you didn't watch the video or read Mark in a minute from last week, Please do that. It's really important. Stage three is when the Fed in a tightening cycle stops raising interest rates. So on May 3rd, we think that'll be the last rate increase. If not, then it's going to get really ugly. But on May 3rd, that'll be a total of 5% in just over a year in terms of rate increases. Massive, right? Massive and very quick. So once that is done, we think the market may continue to rise. It's risen already, right? So the market rose in anticipation of the Fed already cutting rates. Now it's in that phase where, okay, there's still some more upside. However, if as time goes by and those rates stay where they are, it's going to cause damage to the economy. So the market will follow earnings. So the earnings reports for 2024 need to be higher in 2023. We're not too terribly concerned about the estimates for 2023, but 2024 needs to show a positive progression, and 2025 needs to show an improvement over 2024. So we have some comfort in that we think 2024 is going to be higher based on what's happening in the most economically sensitive companies in the stock market, the cyclical companies. So what's happening in this group, in the cyclical stocks, Dow Chemical as an example, is they've had a massive inventory contraction along with slow or negative GDP growth. As you remember, last year we had 2 quarters of negative GDP growth. They didn't call it a recession, but it was a recession. So what's going on is the inventories are back down way below where they should be and need to be rebuilt at the customer level. The cost structure of these companies has shrunk quite a bit. The capacity has shrunk quite a bit. So these companies are lean and mean with inventories well below where they should be. And so just by doing nothing, just by riding a normal inventory cycle, they're going to have up earnings after this quarter. So the earnings for Dow Chemical will probably come in like 30 cents a share, something like that. And then the next quarter, the second quarter, will be up. They'll be up 100% from the first quarter and show the progression into 2024 and 2025 likely. So as you look at the earnings trends of Dow, 2021 was almost $9 a share, 2022 $6, 2023 is going to be somewhere around $3 a share, so massive decline from where they started at the peak 2021. Then in 2024, it'll show an improvement, roughly 40 or 50% improvement versus 2023. 2025 will probably show, again, very strong progression from that level. And we'll probably see another positive progression in 2026 and potentially 2027. So the cyclical parts of the stock market, the cyclical companies are bottoming out, which gives us confidence that 2024 will be positive versus 2023. If not, there's significant downside. And you know what sector is not cyclical at all? Is the biotech group. So there's some heat happening in biotech. I would definitely check that out, or you can contact us about it, or contact me about it. But again, for the stock market to hold up, 2024 needs to hang in there. Thank you very much. We hopefully you found this helpful. Go to my website, Patrick Adams CFA. You can sign up for Market in a Minute, get a hard copy of it. And we hope you like the video and subscribe to our channel. Take care.